Good morning and good afternoon, ladies and gentlemen, and welcome to unit number 1. Put them together, you got 11. Accounting. This video series is for my 7th grade Introduction to Business Management and Administration students. However, if you stumbled across this video and you're in my 8th grade course, you can use the information here to help with the information presented in business management and entrepreneurship, because I only took a couple of key highlights for that lesson, and this expands upon what you learned and was delivered there. If by chance you stumbled across this video from the internet, which I can't imagine why you would and want to be watching this thing, but hey, welcome to my video series on accounting. This is for middle school, so I hope you're able to take something from this. All right, so the accounting, the career cluster, and introduction. The idea here is we're going to present you with the basic ideas of accounting and then introduce you to some of the career opportunities. All right, so here we go. Let's get this party rolling. All right, so the big ideas. We're going to be able to answer what is accounting and accounting management. What is accounting and accounting management, and what does accounting oversee? What does accounting oversee? Okay, so here's the deal. When it comes to accounting, you are concerned with things that have happened. What is currently available to you at this moment. In other words, it gives you a snapshot of the now and the past. If you're concerned with the future of something or you're investing something, then you're looking at finance. Okay, so finance, future, accounting, now, in the past. All right, I hope that helps you out. All right, so what does accounting or accounting management oversee? All right, so if Mr. Cooper were to walk in, Principal Cooper were to walk in and say, what are we learning about and what is accounting? You should at least be able to answer one of these questions. All right, so our essential questions. We're going to look at what are the various roles in the accounting career pathway. Because believe it or not, it's not just accountants. Okay? It's not just some guy that goes around with a pocket protector in his bag or in his shirt with a whole bunch of pins, randomly pulls out a calculator and goes, yeah, I like money, but you clearly paid way too many. You could have saved 4 cents by going with a different brand of pencils. No. That's not what we're talking about here, right? So, yeah, it's more than just accountants, right? We're going to look at some basic terms and basic concepts for the field. We're going to look at possible careers. We're going to look at common characteristics of those in the career. Again, accountants aren't pocket protecting, wearing geeks going, I like money, right? Not what they do, okay? And we're going to look at some of the changes in the field and how it's evolving and some of the skills required to successfully enter the career. All right, so here we go. A brief review from our general management unit. They oversee, or accountants and accounting management oversees the accounting needs, right? Dealing with money. Again, money from the past, how it was spent, how it was utilized, right? And currently looking at today. So from today backwards. They might oversee finance, okay? In other words, if the business is structured where you have an accounting office, okay, and they also oversee accounting, that's great. But you might also be operating accounting under the CFO, which is the Chief Finance Officer. All right, so yeah, each business is structured different. So it says oversees finance. You might oversee finance. It depends on the business structure. Okay, they assure that financial and accounting records are in order, taxes are paid, monetary assets are in place where needed. Okay, we'll talk about that. And then it is defined as the process of recording, measuring, interpreting, and communicating money data or financial data. Okay, let's repeat that because you're going to see this a couple times. In other words, this might be on a quiz, right? It is defined as the process of recording, measuring, interpreting, and communicating finance data. All right. How important is it to pay your taxes? Mr. C, take a moment. All right. I'm going to give you the awkward pause thing here. Go ahead, Mr. C, walk up to the computer. I know you're walking around. Go ahead and stop the video, and let's see what the opinion is on paying taxes. And look at the taxes from both the idea of personal taxes and business taxes. All right, awkward pause. All right, we're good. All right, so there we go. All right, so I hope you got some information from that. All right, so this is a brief review from accounts payable, accounts receivable, okay? Earlier on in the semester, if you were in class, we talked about introduction to accounts payable, accounts receivable. That is a division of accounting, right? We learned that a check is a written order on standard form directing a bank to pay money from a specific source or account. In other words, when you write a check for somebody, right, you are telling your bank, I want you to pay them and only them on my behalf, okay? That's what you're writing. You're writing an order. It is a legal agreement, okay? In other words, it's a legal agreement to the person you're writing it to says, hey, if you bring this to my bank, okay, they will give you this money, okay? There you go, okay? So, a payable then, when you see your accounts payable, is the amount of money you owe creditors in return for goods or services they have delivered. In other words, if you owe somebody money, you have a payable. Why? Because you need to pay it. Believe it or not, when we go to a register, okay, a cash register, so like we go to Publix, right, or Target, and we ring up all of our items, and the lady looks at the thing, that'll be $18.50, please, okay? What they are really saying is you temporarily have a temporary payable that needs to be paid. Now, that payable may only be there until the transaction is tendered meaning finalized, right? But it's still a payable, okay? Now, a receivable, on the other hand, is the amount of money owed to you after goods or services have been purchased. In other words, if somebody owes you money, you have a receivable. You're waiting to receive the money. Now, here's the thing. With businesses, those payables may not be paid for a time period. It might be 30 days, okay? 30 days is the standing billing period, okay? I have a business that I operate, On the Mic Entertainment, okay? So, if I were to go somewhere and I have an account with them, I could say, hey, go ahead and put this on my bill. I'll make sure I take care of it when I'm billed. That way all my bills are paid at the end of the month, okay? Great, I could do that. I have that option as a business and a business owner. And the expectation is that when I receive that bill or that invoice, I pay it right away, okay, because I have that payable. The accounts payable department assures that those are taken care of and handled correctly and on time. Same thing with receivable, right? If I'm waiting to receive money from somebody, right, I have probably said, hey, that's fine. Here's the invoice. Take care of that. Here's my address. You can send me a check. Okay, as long as it's taken care of within 30 days, okay, that's fine. And then it's my responsibility to make sure that I get paid, all right, a receivable, all right, so we also learned that a log or register is a record of transactions. In other words, it's not that thing that fell in the forest and is collecting a bunch of bugs. That is not the logs we're looking for, all right? It is where you are recording your transactions. How do you know where you spent your money? Okay? You got to figure that out, right? And you can't just say, oh, I'll memorize that, because when you're dealing with a bunch of transactions in one day, it's not easy to memorize, all right? We also learned that a credit usually means right side in the accounting column, and a debit means left side in the accounting column. Usually a credit, puts money into the account, and usually a debit removes money from the account, right? That's why they call them debit cards, right? Because it's a bank-issued card attached to your account that when you swipe it somewhere else, that money is removed immediately or debited immediately from your checking account and used to pay the individual person that you made that purchase from. Now, when I say column, why in the world is that important? Don't they just do math? They just do plus, minus, minus, plus, 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 plus. Well, that could be confusing. Let me show you, okay? This is a typical checkbook register or checkbook log, all right? So over here, we see that debit, sure enough, left. All the money going out of the account is over here. All the money coming into the account is over here. Why is that important? So that accountants can look at the last number, look at this column and say, oh, all of these added together equals this much leaving the account. All of these added together equals this much going out of the account. That has nothing to do with the running balance. It has to do with the snapshot of the moment. Remember, accountants are concerned with the money available at that time, right? The resources available at that time and what has happened in the past, okay? Standard accounting principles, all right? All right, so now we're getting into the nitty-gritty here. Okay, so accounting, again, the process of recording, measuring, interpreting, and communicating financial data. It's like deja vu all over again, isn't it? Yeah. Okay, so there you go. Now, here we're going to get into some new things. We heard about that word asset. Financial assets are available where needed, okay? Here's what an asset is. An asset is property owned by a person or a company. It holds specific value, Okay, everything in regards to the business has value. Okay, if it's a physical item, it has value. Okay, now you can't have services on there. Okay, you can have assets as far as the accounting concepts. Okay, because they are valued at something. And the reason that accountants want to figure these things out is so that they know how much is available, how much money the company has available to them, right? And the current worth of the company, okay? And I'll show you how that works, okay? Here we go. Together, pencils aren't worth a whole lot, right? All right? Yeah, you go buy pencils and you get them like for like $1 for like a 6-pack from the store, right? From the Dollar General, okay? Maybe a 10-pack, all right, for $1. Okay, yeah, not that much, right? But if you have a business and you have a big business and you have boxes and boxes of pencils, that might be worth a certain amount of money. Paper, filing cabinets, computers, right? All of those things hold value. Now, what if your business owns a building? How does that get valued differently than pencils? How does the building get valued differently and the land that it's on get valued differently than, say, the computers or cars or equipment? All right. Well, they are put into 3 categories. Okay, so assets are put into 3 different categories. Right. You got cash asset, you got current asset, and you got fixed asset. All right. By the way, this is free college level education right now. If you were to take a sophomore level accounting class, you would learn more about this right here. But look at this, free college education in Mr. C's business class in the 7th grade. All right, here you go. All right, so a cash asset is something that can be converted to cash in less than 30 days. In other words, if something were to come up and the business needed money, right, like to pay its creditors or something like that, they could take their cash assets and sell them. Okay, so cash assets. And those are usually going to be items that need to be sold fast in order to maintain their value. Okay? Example, pencils don't hold their value for very long. They're cheap anyways, right? But the older the pencil end is, the older the pen is, the older the filing cabinets are, right? Those things don't hold their value for very long. So usually it's going to be cash, right? Usually it's going to be inexpensive items like office. Like the term is staples. And I don't mean like a stapler, but I'm talking like folders, small filing cabinets, easels, pens, things like that, okay? In an office, or maybe styrofoam cups, or in a restaurant. You get the idea? Okay? Now, a current asset holds its value longer than a cash asset. In other words, it stays and holds its value and doesn't depreciate or lose its value as fast as a cash asset. All right, so it's a current asset is a short-term asset that can be converted to cash or sold. In other words, it holds its value a little bit longer than the cash asset for less than a year, but you want to try to sell it. I'm sorry, for more than 30 days, but you want to try to sell it in less than a year, all right? So between a year and 30 days. Those are going to be things like automobiles, large equipment, maybe computers, okay? Computers do depreciate fast, but you can still get some pretty good value if they're fairly newer computers, right? Larger pieces of office furniture like desks, chairs, large filing cabinets, those sort of things, okay? So, a current asset, all right? And then there is a fixed asset. Fixed asset is a long-term asset that can be converted to cash or sold in more than 1 year. Okay, that's going to be like real estate, because real estate is pretty much the only asset that can actually grow over time, all right? Or stocks or bonds, other kinds of stock purchases that maybe have been invested by the company. And believe it or not, companies invest too, okay? So you got cash asset, right? Like staples, inexpensive things that lose their value fast. Current asset, things that hold their value a little bit longer, but not as long as a year. That's going to be cars, equipment, trucks, maybe tools, okay, depending on the tool, okay? Those sort of things. If you're in a restaurant, maybe the fixtures in the restaurant, okay? Like the ovens and tables and what have you, and chairs. And then, of course, you got your fixed asset is the actual property itself if you own the property or other investments, all right? Now, the reason that they put value, again, as I mentioned before, is if something were to happen, like the business decides to sell out, right? Or somebody wants to come in and buy their business. They want to see how much assets are available to them. It's something that the accountants need to be aware of and account for, okay? And keep an idea of their cost invested, all right? So, again, current asset, cash asset, fixed asset. All right. And that's all important there because you are trying to figure out basically the balance sheet, okay? Now, this area here, okay, this area here is definitely high-level college stuff. I'm not going to test you on this, all right? But I do want you to know a few of these top two ones. These top two ones I want you to be familiar with, all right? So, liability. Okay, liability is monies that are owed to other entities or individuals, okay? Monies that are owed. So, it's kind of like a receivable. I'm sorry, a payable. A payable, okay? It's kind of like a payable. Remember I said a payable is something you have to pay, all right? A liability might be, say, like a loan. Why is a loan a liability? Well, if you're thinking, well, there's a risk involved, right, because you may not be able to pay that loan, you're absolutely right, okay? So a liability is any money that you borrowed as a business, okay? Monies that are owed to other entities or individuals. Or maybe somebody gave you a temporary loan and said, here, I'm going to help you start your business, but I expect to be paid back after time, okay? That's a liability, all right? Equity is the value of property beyond what is owed, okay? So when your company starts, you might have high liability and lower assets, okay? However, as time moves forward, you might have more assets and less liabilities, okay? So that would be an equitable position, all right? I'll give you another example of this, all right? Let's say, and I'm going to pull out my Post-it note here, right? Let's say that I have a car, right? And I'm going to write this down. I have a car that I paid cheap, $12,000 for new, right? And 2 years later, I go to, I want to trade the car and get a newer car, right? And let's say that I still owe $10,000 on the car, and the company that I want to sell it to says, nah, we think the vehicle is actually worth about $6,000, all right? So, $12,000 is what I paid for it new, $10,000 is what I currently owe the bank for it, and $6,000 is what it's currently worth, okay? Or what the business says that it's worth, right? That means I owe $4,000 more than what it's worth, okay? That means I am in an inequitable situation, right? Now, if this was reversed, okay, and so like I bought the car for $12,000, I only owed $6,000, and they say the car's worth $10,000, okay, then I am in a good spot by $4,000. It means I am $4,000 in equity, okay? Equity is the value of property beyond what is owed, okay? I am going to quiz on that, all right? So just be aware of that, the value of property beyond what is owed, all right? Now, as far as these other college level concepts, I'll go ahead and introduce these to you all. It's good to know them if you're going to go into accounting, but you don't have to know it for this classroom, all right? Stockholder equity, okay? If people have invested in your company and they're not banks, okay, they are stockholders. They are saying, I'm going to give you money, but I want share ownership of the company, all right? So stockholder equity is the value of the business divided among its owners or stockholders, okay? You might be the one who's operating the business and the primary stockholder, right? But everybody else who's invested, right, are partial stock owners, okay? So stockholder equity, the value of the business divided amongst its owners. Now, here's the thing, all right? Just like the car, okay? If the value of the company is only worth $6,000 and everybody's invested $10,000, okay, they are in an inequitable position, okay? What does that mean? Well, each case is different, all right? So you want to make sure that if anybody's investing, that they're investing in making good decisions, okay, and building towards stockholder equity. Now, to get an idea of the financial health of a business, people do, or businesses do, what they call a balance sheet, all right? So in other words, assets, the property, right, the things that are owned, must always equal what is owed and what is invested, okay? In other words, the property available for use by the company must always equal what is owed, all right, plus what has been invested, stockholder equity. All right, guys, that brings me to the end of this video. Don't be confused by this slide. There is a crossword associated with it. So all you got to do is do a crossword and match the definitions there, and that should get you rolling. And I will see you next in counting video number 2, where we'll start diving into some of the career options and choices.